Minutes talking about that. We're going to get on to what this show is about, and that is technical analysis training. And I'm going to do a whole series of technical analysis, and you're probably saying, but Ernie, you say that technical analysis is bullshit. I've never said technical analysis is bullshit. What I've said, and I want to be very clear about this, using technical analysis as your strategy is bullshit. Using technical analysis as a way to model your strategy and to model the edge that you have through a more ethereal or more definitive edge that you found in the market for a particular reason, maybe some fundamental reason or some thing that happens in the market, some event or some pattern that you've seen. Then you can use technical analysis to kind of expose it, when that pattern evolves so that you can get in, get out of that trade. There, technical analysis is useful. Now, most technical indicators are deceitful, and you should read Fooled by Randomness if you want to learn more about that. People put way too much weight on the various technicals, thinking that that gives them an edge or that will give them some sort of predictive power when it doesn't. Most indicators or series of indicators or patterns that evolve also are very context sensitive. So if the context does not present itself, then it doesn't matter if the pattern is there or not. It may be useless if the context isn't there. So these are all really important things that you have to know about technical analysis. The other thing that I'll say is that there are certain things that have a higher probability than others. Much higher probability. Most technical indicators are, in terms of their predictive power, are really not much better than a coin flip. And sometimes even worse than that. A good example of that is this, the golden cross or the death cross. Either of those, either situation. That's where the 50-day moving average crosses the 200-day moving average, either to the downside or to the upside, which would either make it the death cross or the golden cross, respectively. If you were to then go out and map this and backtest this strategy, you would find that the predictive power of that moving average crossover only has about a 35 to 40% win rate. I mean, that's friggin' pathetic. Yet people turn to it as if it is a fait accompli. That is, that if we have a golden cross or death cross, then the prognostication is sure. And it's just not. Again, it depends on context. As a general rule, the best technical indicator that you can use is determining the trend. So if you, and regardless of what indicator or moving average that you use, if you can determine the trend or the direction of the trend and the strength of that trend over some period of time, then that will give you a bias. And that bias then should tell you that you should only trade with that trend. So any trades that you take are only in the direction of that trend. You shouldn't be looking at things that go counter-trend, unless you have something that will determine a counter-trend. So there are basically two different types of things. Either you have a counter-trend, a trend, and then the other situation is channel-bound or range-bound or going sideways. Those are basically the three different ways that the market can move. You will have your highest probability of success if you trade with the trend. Channel-bound is a very difficult thing to trade. However, it's possible, trading sideways. But it is difficult. Reversals are another thing that, with proper volumetric analysis, you can get a higher degree of prognostication or success. But again, volume plays a very important role. And let me say this about volume. So first of all, there's the trend, understanding which way the trend is going. So what I'm doing is I'm providing what I think are the tenets, the basic tenets of technical analysis, the things that are probably most important in your trading. First is to determine the trend. And note that trading with the trend is, by and far, by a huge margin, the most has the most potential for profit. All right. And then, as I said, I'm going to repeat it again. There are 3 different types of trends. There's a bullish and bearish trend, a very strong or weak trend. There is a reversal, and then there's range bound, or a channel, sideways. Those are the 3 basic ways that the market moves. It was really the only 3 ways that the market moves. The other really important thing is the volatility that's in the market, the amount that the market is moving, either up or down or changing. Its rate of change is very important. So you could be in a trending market and still have a relatively volatile market if you have a lot of rate change. So you could be doing like this, but going in one direction. There is a limit to volatility that beyond which it is useful. But having volatility is useful. Having low volatility is a very, very difficult thing to trade. Low volatility is you can equate that or give an analogy that is like having low blood pressure. Very low blood pressure is not good for you. You're not supplying the muscles and the brain with an appropriate amount of oxygen through the blood. And it's the same thing with the market. If there isn't enough volatility, you're reducing your potential for profit, because your trades are going to be a result of that volatility and the troughs the difference between the trough and the peaks. And the more often and the greater those troughs and peaks are, the greater potential for you to make profit. Now, this is antithetical to the way most people think about volatility. They want to try to avoid volatility. But in fact, you should embrace volatility, that change, that rate of change is what you're seeking. Now, of course, there is a point where it gets to that point where it is untenable. And here you can use the analogy of, say, a water spigot. I don't know if you're familiar with this, but a lot of houses, places have water spigots where you can plug in a hose and water your lawn. Before you plug in that hose, though, and you turn on that spigot, when you first turn it on, just very, very lightly, and it starts dripping out, and you turn it on a little bit more, and it starts sort of spattering, right? That's an instance of very low volatility, low volume, and it's very unpredictable. But as you turn that spigot up, there's a sort of really nice area, the heart of that volume where the water comes out in a nice stream. Then if you keep on turning it and bring it up so that the water pressure is just way too much, that nice stream starts turning into this chaos again. So there's a sweet spot with volatility, and as there is with opening up a water spigot or that volume that's coming through. And that's what you're looking for. And that sweet spot can be rather large, but you need good volatility to be effective. And you'll find that your profitability and your rate of success will increase dramatically when you're in that sweet spot. All right, so we've talked about a bunch of things. We've talked about trend. I haven't really talked about how to identify a trend. I mean, there are many different ways. We can look at that in maybe separate episodes. And talked about volatility, how important that is. And we've also talked about technical analysis is not a strategy in of itself. Technical analysis is not a strategy. It is a tool for modeling strategies. And that's it. And if you think it's a strategy, you're going to fail. All right. So we have trends, strategies, volatility. All three very, very important parts, very important points. Now here's another very, very important point, and that is the time frame in which you work in. Now, a lot of people say that, well, there has to be a style that is coincident with what works best for them, what they're familiar with, or what they're comfortable with, what trading style. And there are essentially three different trading styles that are mapped directly to time frame in which you trade. The shortest of the time frames is something they call day trading. Actually, there's something even shorter than that you would require computing power and scalping and front-running arbitrage, high-frequency trading. But we're not talking about that. We're talking about trades that are taken within a day and closed within that same day. That's a very short-term trading. Then there's the next level, which is often called swing trading, which is a little bit longer, where you may open and close in the day, but you could possibly hold it for several days or a couple of weeks. And then there is trend trading or position trading. These are where you open trades that may stay open for weeks, months, maybe even years. The one thing that you should note between these three different styles of trading is that the opportunity increases as the length of time of the trade increases. The probability of profit decreases as you go to shorter trades. This is why virtually all the most successful traders in the world are long-term trend traders. There's virtually, or hardly any, there might be a handful of very, very special people that have made it big by doing day trading. Very, very few people. When you go all the way down to high-frequency trading, that's a completely different story. That is complete computer assist, right? And that is an arbitrage. That is actually an arbitrage is an actual guaranteed winning trade. So Jacob says, when tested, channel up strong and channel down strong have proven to be the most effective indicators. That's probably true. Again, trading with that trend. Trading the pullbacks when you have touches on that channel is actually one of the most effective technical indicators, technical ways to take a trade in a trend. Some people like breakout trades. While they can be effective, they are, from a probability and percent win and return on capital point of view, a breakout trade isn't nearly as effective as a pullback trade. So these are all, okay, let's see here. Alex Crypto, hey Ernie, Happy New Year. All serious today, huh? You even got clean shaven for us. That's right, I shaved. But that, I'll shave probably once a week. And that's originally why I sported the beard, because I was just so sick and tired of shaving. I might go back to that, but not anytime soon. All right. So we've gone through a lot here. And I will have to agree with Jacob about the channel up strong, channel down strong. Strong trends that follow within a channel are definitely the easiest things to trade. By far. But again, I want to make the point that is not your strategy. finding strategies that have some kind of edge, and that means that being able to identify some kind of market factor, something, a pattern, an event, some cyclical thing like seasonality or whatever. Those are the things that give you the setup. It could be economic reports and how you actually trade those. It could be, volatility trades, the idea of expansion and contraction of volatility. These are the things, these are the strategies that you need to put together and then use technicals to identify opportunities within those strategies. All right. So we talked also about time frame. Now, a lot of people feel more comfortable trading short term because they get that immediate result, that immediate rush if they are winners. But there are very, very few people that win at short term trading. It's very difficult. And on top of that, you shouldn't be concentrating on just one style of trading. You should kind of spread that out. You should have a number of different strategies that are short-term, medium-term, or swing trading and position trades, and lean towards the position trades because those are the ones that are going to bring you your biggest profits and give you the best probability of profit as well and return on capital. So you need to have a diversity in terms of your strategies that are applied to time frame as well. All the greatest traders, that's what they do. All the greatest traders, most of them lean towards long-term trades, but find opportunities in the medium and short-term trades, and then take them when they can. But they don't concentrate on any one thing. And that gets me back to my ultimate thing, and this is very difficult to do as a discretionary trader, a non-systematic trader. You have to be somewhat systematic as much as you possibly can. Being discretionary isn't bad, it's just more difficult. It makes it easier when you have definitive strategies and that you can follow some set of rules and platitudes and risk measures and tenets and philosophy. All of that stuff is really, really important. So, yeah, I can't even see. How do I look? Oh, you look good, Ernie. You look marvelous. So this is all, again, the intro to technical analysis. This is the big picture and what you need to, and I'll dive into individual things. And when I talk about strategies and diversity of strategies, and you've probably heard me say this a million times, that it is better to have more than one strategy. As a discretionary trader, I hope you have at least 3, 4, 5, maybe 10 different strategies that you can employ and put them into use. And in fact, this is what we do with the AI setups. There are actually virtually unlimited number of strategies that are all non-correlated with each other. Having and being able to have multiple non-correlated strategies will give you a type of convexity to the market. Another word for that would be an anti-fragility. The ability to be able to step into the fire, and then as that fire intensity heats up, your trading should get stronger by having this diversity. Now, all of this sounds like really complex, and it is. But trading starts becoming really simple once you have these tenets, these ideas, this philosophy in place, and you have that discipline to be able to act on it. Trading strict technicals will definitely ensure that you are a loser. Absolutely. Okay. Let's see, what else? So the intent of this session here was to give you this sort of really, really big picture and how everything works. What you should be leaning towards, what is ahead of you, what is it that you need to grasp a hold of before you can be an effective trader. Now, some people may start in and get a good sense of this and develop and have a certain type of intuition and be able to be successful right off the bat, and then find later on that their success may wane and not understand why. Other people may struggle for years, even decades, before they become successful. Maybe not until they've met up with a mentor, or maybe somebody gave them a system that envelops a lot of these ideas. And that's actually, again, that's something that we offer, the AI setups. That is such a system. I call it the embodiment, because it embodies all of these ideas, this philosophy, this carapace, this big picture, these tenets of trading, all into this package that reduce a lot of that risk for you, allow you not to have to deal with the risk measures, deal more with the execution, position size, managing your winners instead of managing the risk. That's ultimately where you want to be. You want to be able to manage your winners and not have to worry about the risk. Let the strategies and your big methodology and philosophy take care of the risk automatically, or I should say automagically. And that's possible. Most people are concentrated 100% on that risk. And then that causes them to make bad decisions. I still fall into that category every once in a while, but I'm getting better at it. Now, I mean, I learned these things from, I've had two primary mentors that both were unbelievably successful traders. I mean, people that have made literally, one made 100 million, the other one close to it in their lifetime. And it took me nearly 5, 6, maybe 7 years before I started to get it, even in their tutelage, under their wings, so to speak, before I got it. And even now, I'm still struggling with some of those things. But I see it, once, and I can model it. Once you're in that kind of groove and you play by these rules, you will, more often than not, come out on top. All right, let's, and I know that this is sort of extended. Need the glasses now, and we'll go to the, we only have 24 people watching. Isn't that something? Trade Doc, hope he gets better. Thank you. He's talking about Neo. Hayseed says, trading, hardest way to make easy money. Yep, and I've said that's actually something from one of my mentors. And it took me a few years to understand exactly what that meant. I mean, everything that I just talked about is an incredible body of knowledge that you need to envelop and embrace. And it's not easy, but if you feel like you can fit inside that space and understand it and create some strategies and then develop the discipline and the execution prowess, then it starts becoming easy. You start seeing the light. Then you start managing your winners instead of chasing risk. Yeah, it's hard, but once you get the hard part down, then it becomes easy. It's a lot like pool, I mean, you see a lot of barroom gadflies that will try to play pool, and they can knock it around and knock the balls in, but they don't compare to somebody that can get up there and then it looks like they effortlessly clear tables. And that's because they've put the hard work in. They understand every little aspect about that game, the geometry, the conditions, the opponent, the strategies, the patterns. Well, thank you, Iceman. Nathan, just got in. What's been said about the technical analysis workshop? Nothing. We have not said a friggin' thing. You'll have to go back and look at it. Wahim, how you doing? What leverage you recommend to trade Bitcoin? Well, first of all, I don't recommend trading Bitcoin. I think that Bitcoin is going to be, in terms of leverage, why would you want to trade leverage with Bitcoin? That makes no sense whatsoever. I can see Bitcoin and whatever strategy you have for it being a minor part of an overall trading strategy. But Bitcoin is highly manipulated. Not that most other things aren't highly manipulated, but definitely much more so than most, and very unpredictable. And the fundamentals are going to be kind of flat for the next year or two. So and for me, for that reason, I've developed a strategy that makes it very, very simple. You just short every friggin' rally. That seems to work until it doesn't. But I leverage on Bitcoin. First of all, leverage can work for you or against you. It's good to use leverage in a lot of different things, but if you can use it within the context and you can position size your trades appropriately. I mean, if you have a lot of leverage, then you shouldn't be having big position sizes. You should have very, very, very tiny positions. So if you're going to use leverage with Bitcoin, have tiny, tiny positions. If someone cannot utilize your AI setups, what's the next best thing? Learn, practice, get a bunch of strategies under your belt, become disciplined at it. But I'm not sure why someone couldn't use the AI setups. That doesn't make any sense to me. Mail to Praj. Ernie, what's your weekly Bitcoin prediction? Well, let's see what's happened. I haven't looked at it since this morning. And really, no difference here. I mean, Bitcoin, I think it's still inside of this pennant, or what is really a bearish pennant. If I bring this all down here, you'll see what I'm saying. The bearish pennant that I've been talking about a long time. There's the flagpole. Well, let's get rid of my head here. So this is a good example for technical analysis. Now, I've already developed my trend. My trend analysis, really, it's pretty simple. Bitcoin's trend is down. The major trend. There may be intermediate trends and short-term trends, but the big trend is down. Therefore, I can only trade in that direction. So that exemplifies my very first rule of trading. Always trade with the trend. Always. Unless you have an extremely high probability trade with an edge, a definitive edge that you can prove out statistically that you can either do a counter trend or a sideways trend, channel trade. But you should favor trading with the trend. In this case, I trade any pattern that will show me a bearish setup where the supply and demand are in my favor. I use volume profile as another way. That, to me, volume profile is the most superior technical indicator because it does tell you what the structure of the market is. And by knowing that structure, and we need my face here for this. You need my face when I talk like this. By knowing the structure of the market, that allows you to predict the behavior of price as it moves across that structure. It's a lot like you riding across a terrain, and the behavior of your car is going to change dramatically depending on whether or not you're on a flat plain or hills or whatever, or going down the side of a cliff. Your car's behavior is going to change dramatically or your ability to traverse that terrain is going to change dramatically depending on that structure. It's the same way with the market. When there's a lot of volume at a particular price has a tendency to gravitate towards that because that's where the market has found value. When there's very little volume at a particular price or range of prices, contiguous prices, what I call a volume well, then price has a tendency to get rejected from that area. Either it bounces off of it or moves through it very quickly. Just knowing those three fundamental things of the way price behaves across price structure can aid you dramatically in making higher probability trades. And without doubt, I think that volume profile is the most effective technical indicator out there. It's not even a technical indicator. It is in fact, the truth. It is showing you both price and volume all in one indicator. I mean, it is more useful than the candles. Although there's a lot of usefulness in the candles, line charts, and the time-based or series-based volume as well. There are patterns there that you need to take note of. And we'll talk about those patterns. We'll talk about chart patterns. We'll talk about candle patterns in future episodes. And we'll talk about volume profile. So right now what I see here in Bitcoin is a very, very large bearish pennant. All right, that's where you have this big flagpole where price moves down very quickly, followed by some consolidation that is diminishing in terms of its range, and at the same time, volume is decreasing across that pennant, that triangular structure. That is a classic bearish pennant. All right, that differs from a flag. A flag is one that has a channel that is moving up. All right, this is a pennant, but almost equally as effective as a flag. And the expectation is that once we break out of this pattern, this consolidating pattern, consolidating with diminishing volume, that we will break down or break in the direction of the previous trend. That's a fundamental thing about, that is a very high probability, better than one standard deviation prediction. So most people in the market were saying, oh, this is a symmetrical triangle and it's going to break up. But are they ignoring the flagpole? Why would they ignore the flagpole when that is a principal part and also indicates the direction of that trend? So it started to break up, and they thought, oh, we're breaking out. And what I saw was nothing more than maybe a redefinition or shape or parallax move of the top side of that pennant. So I just moved it up a little bit. Instead of being where it was right here, I just moved it up a little bit. Made sense. Now, let's say it does break out of here. It's going to have a lot of resistance. And this is going to be going against the trend, a counter trend move. And there's going to be a lot of resistance in this yellow area. How do I know that? Because I've taken a daily chart and then I've brought over the previous data from a while back so that I can see the full volume profile. When I see the full volume profile, I have this big, huge node here. This big node, price will want to gravitate towards the apex of that node. And price will want to get rejected by the big volume well that is above that node, and particularly wherever price drops off dramatically. And that's why I drew this yellow region here. That is a strong area of resistance. For whatever reason, the market doesn't like any price above 44.50, or is not, is not enamored with it, let's say. So price is either going to get rejected by these low volume wells, here or even here where it drops off even further. Or if it gets through there, it's going to move through it very quickly up to the next volume node. It's going to gravitate to the next volume node where the market has found value. But it's more likely that the trend will continue, that we will break out of this pennant, move through the next volume node, a volume well, which is right underneath it, to the next volume node, which is down here around the 2000 area. And you saw that when I brought over the other data. See down here, there's a big volume well followed by a big volume node. If I bring in more data, that it'll increase that node dramatically. Very, very strong node down here. And I believe that this is the next place for Bitcoin to go to. There's a higher probability that it's going to move down to there than move up. It doesn't mean it can't move up. It just means there's a higher probability that it'll move down, at least from a statistical point of view, and looking at, millions and millions of other charts out there. That's where the probabilities lie. Now, Bitcoin is a heavily manipulated market, and so I wouldn't put it past some very well-heeled whales to artificially move this thing up into this no man's land or the big volume well and try to push it up. There's not going to be very much liquidity here, and it may not be that difficult if they have enough billions of dollars to move it up to the next volume node. Problem is that there aren't that many people out there anymore that are willing to throw their money in and say, yeah, we'll take that trade. So I see that as a big problem. Very big problem. It went up level. Not that you could tell. Trade Doc says, do you believe this rally? Second morning, averaging into puts. No, it's not. What rally? There's no rally. Are we talking about Bitcoin? I don't see any rally. It was barely a rally. Now, if it moved up to 44.50 in this area near this yellow region, that's where I would start looking at shorts. If it moves up there, then this pennant starts turning into a flag. I don't see how you get around that. So this pennant will start turning into a flag, which is still a bearish pattern. We could conceivably, watch this. We could follow this pattern here and easily move way, way up here. It may not move that far up. It may move to there. That's something I can see. But price could move way up here. Then it will just turn into from a pennant to a flag, where you have this kind of upward spaced rectangle, and price is contained in here. This would still be amazingly bearish, even if we get way up here, up to 48 or 5,000 area. Still hugely bearish. Nathan's saying, when you say strategies, are you referring to how you use indicators like RSI and MACD? No, those are not strategies. RSI and MACD are not strategies. A strategy might be something like if the crude oil report on Wednesdays shows a higher than expected amount of oil in strategic reserves, that could be bearish on the market, and therefore I would take a short. That's a strategy. Right? That's fundamentally different than saying, oh, the RSI went up to 70. That's not a strategy. Spook asks, is buy-side, sell-side volume worth looking at? I suppose if you can develop a strategy around that, maybe, but I don't look at that. I mean, for shorter-term trades, and maybe for some analysis, it might make some sense, but as a general rule, and I don't want to discount those people that have developed strategies around that. I'm sure that there are some very, very good statistical reports or analysis that have shown some edge. I'm not aware of them. So as a technical trader or a discretionary trader, I would simplify your work. I don't think you have to worry about that. Just look at volume at particular levels. Thank you, Bob. Thank you, Mike. Ernie, do you think Bitcoin will bottom out in 2019? I think that over the next year or two that it will bottom out at some point. It'll hit a low, but it's going to stay within a range, in my view. Ernie, do you think we can go as high as 4,800, 5,500 at this point in this small rally? Again, this is one of the reasons why I drew this flag in here, and this flag shows, sure, we can go up to 5,000, no problem, and still stay immensely bearish. Apple going down, Ernie, just like I said. That's because Smart Nexus, you are the Smart Nexus. Jacob says, if it takes a tiny bit of volume to move something down and a ton of volume to move something up, or vice versa, that tells you something over medium-term time frames. Yeah, resistance is a very good indicator. If something is providing very little resistance, however, you can predict a lot of that resistance or fluidity or liquidity just by looking at volume profile. It tells you a lot of that. But in a shorter time frame, if you see that, if something's having a hard time, take a look at the volume. There are also volume patterns that you could look at that will give you a good heads up for that. And those are actually contained in my volumetric principles 1, 2, and 3, and you can look at those under my Discord group. There are pinned posts that talk about my volumetric principles. Smart Nexus says, I'm shorting Apple to 0. I don't think Apple's going to 0. Someday it will. Mr. Trad, oh yeah, there's our troll. Boomer missed the Bitcoin train. Andrew says, how do you feel about the sentiment of the stock market? Well, right now the stock market has a very high degree of positive sentiment. But sentiment in any market is generally what rules the day. But it's fleeting. Sentiment is fleeting. And a lot of times it is thrashed around on a daily basis based on economic, global, macroeconomic, and political conditions. So understanding where the prevailing sentiment is another factor in technical analysis that's very, very important. One way to look at sentiment, an indicator that might help with sentiment, is the advanced decline line. It's not a direct thing. Some people have far more comprehensive indicators that take in a whole variety of data, including polling, actual polling of people, that will create a sentiment indicator or direction. And even the government has such or there is such a report that comes out, consumer sentiment. Iceman J. I easily get $1,000 worth of value from your free YouTube channel. Thank you. Nathan says it's true. When Ernie started talking about Bitcoin, his views went up 4x. Is that what happened? Oh, yeah, there's 162 people watching now. That's okay. I mean, I do not mind talking about technical analysis in terms of Bitcoin. I mean, it is a great way to study technical analysis. It's just not a great way to study strategies. All right. Hi, Ajit Kumar. How you doing? And James. Oh, do you use R? Anyways, I think that's about it for now. Please hit the like button and share this video out there. This is going to be the first in a series. And look, if you've made some money off of my prognostications and the things that you've learned here, I would encourage you to go over and check out the AI setups. Go over to traderofutures.com. All of this wisdom has been embodied, and that's why I call it the embodiment, into this artificial intelligence system, and it's fantastic. Our record is really proof positive of that. Since we have had the service opened since October 4th, we have not had a single losing day in our trade room. Not to say that there hasn't been losing trades, but we haven't had a single losing day of all the consolidated trades in our trade room. We are approaching, actually we are at about a 90% probability of profit, where we actually make, and this is not hypothetical, although our system is geared towards anything above 80%, it has been overperforming. And we average at least a 25% return on the capital that you use. Please speak in Hindi. I can't. I wish I could. That'd be a neat trick. Sash Saj. It's me again, the BG Troll. What up with the shockingly exploding breakout of Bitcoin? There is no shockingly exploding breakout, although I did say that I was stunned by the breakout, right? That was my last video. What I was stunned by was how all these Bitcoin analysts out there were so amazed and so bullish now with this tiny little blip of a breakout. It wasn't even a breakout. All it was a parallax move. It just changed the upper side of the pennant. That's all it did. Just moved it up a little bit. And it fit perfectly. And if we move up even further, even as high as 5,000, all that will do is turn it into a flag instead of a pennant and still be immensely bearish. All right, now, wow, we got 197 people on. Isn't that wonderful? So we're going to talk more about technical analysis from here on in. I'm going to do a complete treatise on it. So this first episode was really talking about the big picture. All right, talking about trends, talking about volatility, talking about indicators and their usefulness, patterns, talking about strategies as opposed to using technical analysis as a strategy, because it's not a strategy. It is nothing more than a way to model opportunities within your strategy. Talking about the need to have multiple non-correlated strategies as a way to contain risk. And that instead of concentrating on containing the risk, which should be a natural consequence of your overall systematic approach, You should be concentrating on managing your winners. These are all big picture ideas in the world of technical analysis. Also, mentioning the volume profile and volume are perhaps the most underrated pieces of information that most people have no idea how to treat. And that is because of the broker narrative. And I've talked about the broker narrative many times. The broker narrative is designed to make you trade like a fool, to trade and make as many transactions as possible, because that's what the broker wants. That's how they make their money. They don't make money by you making money. They make money by you making trades and by making shorter term trades. That's why I said you should focus and move more towards longer term trades. It doesn't mean you shouldn't have shorter term trades. It means that the majority of your trades should be longer term, because that's where the probability of profit lies. Greater opportunity in longer term, less opportunity in shorter term. All right? So I just recapped everything that I said for Nathan's benefit. Steve says, and especially select your positions so you limit yourself to over trading and try to catch every trade. I can see that in some contexts. But trading small is probably a better way to say that. Keep your position sizes as small as you possibly can. You'll actually make more money by trading small than you will by trading big. Not to say that you can't hit it lucky and trade big and get lucky, but you keep on trading like that and you will bust yourself. Trading small will allow you to sleep at night and allow trades to do their thing without having the need to try to get out of it if it goes against you a little bit. I mean, how many times has a trade gone against you and you got out because it hit your so-called 2-to-1 risk or whatever the fuck it was, and now you're out of that trade and you lost money? If you were trading small enough, you didn't care if it went against you, and then it comes back, then you can profit on that trade, allow it to work, allow your strategy to work. That's the problem. Most people don't allow their strategies to work, mostly because they don't have a strategy. They have risk to reward and technicals, and that's it. You are playing right into the broker narrative, right into their hands. You are a fool. There is no pro trader that trades that way. Well, there are pro traders that do trade that way, and they struggle. But most of the most successful traders out there do not trade that way. I can guarantee you that. They do not trade that way. They trade exactly the opposite. Slash says he knows a guy that can write explosive video titles for me. That's awesome. Yeah, I am. I'm really a believer in that. Clickbait titles and really good thumbnails attract the flies. But I want to thank everybody for showing up here. We're going to do another show tomorrow, and tomorrow we'll talk a little bit more about patterns, chart patterns and candle patterns, and how they can be useful, how to detect them, what resources to go to get good information on them, and maybe even talk a little bit about it from a systematic and automated trading point of view. Yes, Nathan, I do mean swing trading over day trading and position trading over swing trading. Position trading is also known as trend trading. All right. Thank you all, and we'll see you next time. Oh, but first, I have to find the sign off. There it is. Stop streaming here. Bye. See you next time.